Thanks for joining us today here on America's Retirement Headquarters, the home of the Retirement Guys formula and America's Medicare Associates. ARHQ.com is the website. And the phone number is 419-794-3030. If you have a 401k, one of the investment choices you might have is a target date fund. You'd recognize them because there will be a year in the title: 2030, 2035, 2040, etc. The idea is to match the target date fund date with your retirement date, and the fund will slowly move you away from risk. Here's the problem: they don't actually work that well. An article in Barron's focuses on Vanguard and Fidelity in particular, and their quote is, "Had target date funds never been invented and Vanguard and Fidelity instead placed their 401k shareholders into their existing balanced funds, those investors would be significantly wealthier today." That's a pretty damning statement, I would say. But I have to wonder, Nolan, what is your take on the target date fund?
It kind of reminds me of the rotisserie that set it and forget it.
Uh-huh.
I know my wife loves to get ours out, once a year when we do usually something around Thanksgiving. And for a lot of people, they have chose to do this set it and forget it type route. In fact, a lot of times when a 401k changes from one company or to another, the default is ultimately to put those investments into some type of target date investment. My thought process is this, as you get closer to retirement time, so when you're within 5 or 10 years of retirement time, I don't know that a target date fund is necessarily what I would think is the best approach for most of the retirees that we work with. And let me give you an example. I met with somebody here recently. We'll call her Nikki. Nikki had amassed a nice amount of money in her 401k in the target date retirement account. She's looking to retire within the next 5 years. And so, what happens in these target date funds is they will allocate more money towards fixed income, aka like bonds and cash, as they get closer to that retirement date. Well, if we go back and we look at the last couple of years, most of those fixed income bond type of investments really struggled because of the interest rate risk that was out there. So a large portion of the portfolio that was shifted over into fixed income that was perceived to be somewhat of a safer type of investment was actually an investment that, you know, physically, in many cases, the value went down on the statement. In addition to that, the double whammy of that is it didn't keep up with inflation, so you lost purchasing power. And then the triple whammy of that is the fact that it's a retirement account, so taxes haven't been paid on that money. And so it's almost a trifecta of bad things that happened with target date funds over the last couple of years. In fact, the most recent check here at the beginning of July, the aggregate bond index is still either slightly negative or flat year to date. Again, that investor in the target date fund with a large percentage is continuing to lose purchasing power. So the problem here is you ultimately end up with a one size fits all versus a customized approach. What was unique about Heather in her situation, actually, it was Nikki that I was thinking about, but in Nikki's situation, what happened with her is because of the fact that she's over the age 59 and a half, her 401k gives her the ability where she can do an age based in service transfer. So, in my opinion, if we look at where fixed rates are today, to me, there's much more attractive investment options that can eliminate the cost and the risk associated with the fixed income part of our portfolio. I mean, even a money market account today is still earning over 5%. You could put money into an FDIC insured bank CD, and these rates are extremely attractive on where CD rates are at. If you wanted the peace of mind to have that FDIC insured CD, you can get what is called a multi-year guaranteed annuity, where you can go to the insurance companies of America and you can lock in these decade level high interest rates for quite some time. Or even for a risk reduction strategy, money can be positioned into what is called an indexed annuity that would allow an investor to participate in part of the gains of the market going up, but add in some principal guarantee. So that allows a little bit more of a customized approach. On her equity side, most 401ks offer, 10, 15, 20 different investment choices. Half of those are usually those target date funds. So when you narrow it down, usually in a 401k, you have limited choices. But again, using that age based in service strategy allows somebody to have a completely customized approach of how to build out the overall portfolio. The other issue with a target date fund is the asset allocation shifts are really not flexible. It's going to target that date of when retirement is. So if the target date's 2025, it's assuming the person in that investment is going to retire around 2025. And so it's going to make those changes. And what it's not going to do is it's not going to typically adapt to the current market conditions, meaning that the fixed income versus equities are not going to take into consideration, where we're at in the economic cycle. They're just going to stick to what their mandate is. In this example, a lot of these target date funds could have significant risk, even for somebody who is close to or in retirement time. And then, if you look at again the last couple of years, with most of these target date funds have struggled either to have minimal gains or flat. You have somebody that's close to retirement losing, 3 years of an opportunity within their plan. I think that utilizing a more customized approach and or looking at the investment choices that are available is a much better solution. What we have is we have a technology platform that we put together, and what we can do is do a couple different things. Number one is we can take a look at the investment choices that you have within inside of your plan, and we can tell you what we believe to be some of the you know best choices based upon your individual goals and objectives. We can give you advice on what's called strategic asset allocation, investing in large, medium, small, international, and also we can give you ability to add in like a circuit breaker on your 401k. So if and when the market has a technical breakdown, we can email or push notification alert you to take defensive measures to protect your portfolio. And while the market is at a record high, now's the time to be thinking about, adding in downside protection into the plan. The software that we use, you can check it out. It's planconfidence.com, or better yet, if you want that specific advice on your 401k, all we have to do is get a copy of the investment statement, and we can do that analysis and give you feedback. So if you're in a target date fund, or even if you have like a variable annuity and you're in a target date variable annuity, you could be stuck in a mediocre approach, where, in my opinion, that customized approach can be much more tailored to your individual likes, goals, and objectives. And there's so many great choices out there. We'd be happy to walk you through it.
We don't want to make it sound like, if you elected to go into a target date fund when you first invested in your 401k, that is an abject failure on your part. No, any money saved towards retirement is better than nothing, but you don't want a better than nothing retirement. You want a retirement that is going to work for you. You want that money to work as hard for you as possible as you've worked for it. And so that is where we're looking at other investment strategies, perhaps shifting that money out, especially if you can do that rollover, really comes into play to see what can be done and how to go about doing it. Schedule the time to speak with the team at America's Retirement Headquarters. 419-794-3030 is the number. You can also go to the website, arhq.com.